Budgeting exercises. First question. Smithson Corporation has the following budgeted sales for the selected 6-month period: June, July, August, September, October, and November. And this is the unit sales. There were 7,500 units of finished goods in the inventory at the beginning of June. Plans are to have an inventory of finished product equal to 20% of the unit sales for the next month. 3 pounds of materials are required for each unit produced. Each pound of material costs $20. Inventory levels for materials equal 30% of the needs for the next month. Materials inventory on June 1st was 5,000 pounds. Required, prepare the production budget in units for July, August, and September. Prepare a purchase budget in pounds and dollars for July, August, and September. So let's take a look at the answer. Okay, so July, August, and September, the sales. So we put the sales, the desired ending inventory. Okay, 7,000. How you get 7,000? It's here, and August and September. So the total needs is 37K, 40K, and 31K. So less the beginning inventory. So 4,000. Get from these calculations. And then you get the units to be produced. So on with the other month. Okay, for B, okay, unit to be produced is what we calculated here. We put there. And then desired ending inventory. The first one, okay, this is the workings. Okay, you can take a look at the workings. And then the August, and then for the September, this is the working, right? And we get the production needs. Okay, so you can refer to the workings here, and then get the total needs and then you left with the beginning inventory purchase needed in okay 78K for July, 92.7K for August, and 79.8K for September. And you time with the cost $20 and you get the total purchase cost. Right? For question 2, Johnson Company has the following projected account balances for September 30, 2006. So the account payable, account receivable, depreciation, inventory as at as the 31st August, inventory as at the 30th September, material use, office salary, insurance, factory wages, bonds payable, sales, capital stock, retained earnings. You have to figure it out. Maintenance, factory, cash, equipment, building, utilities, and the selling expenses. So first requirement, prepare a budgeted income statement for September 2006. Prepare a budgeted balance sheet as of September 30th, 2006. So the answer is, okay, you put the title, and then the sales, and then you calculate the cost of goods sold. Okay, so you get the gross margin 194K. And then let's with the operating expenses, right? So you get net income 124K. Right? And B, put the titles. And this is the balance sheet. Actually, okay, just for your information, right? Actually, we don't ask about the balance sheet. Okay, never mind. Okay, question 3. This is past year's questions. So let's read the questions. Andaman Berhad prepares monthly cash budget. Relevant data from operating budget for 2004 are so January and February. You get the information of sales, direct material purchase, direct labor, manufacturing overhead, and selling and administrative. Alright, all sales are on account. Collection are expected to be 50% in the month of sales, 40% in the first month of the following sale, and 10% in the second month following the sale. 50% of direct material purchases are paid in cash in the month of purchase, and the balance due is paid 30% in the first month following the purchase and 20% in the second month following the purchase. Manufacturing overhead and operating expenses are paid in the month incurred. Selling and administrative expenses include 1,000 RM of depreciation per month. So this is the additional data. Sales in November, this is the amount, and December, this is the amount. Purchases of direct materials, so for November and December. Other receipt for January 2004, proceed from the sales of Tukun National Berhad, 35K. February 2004, proceed from sales of old machine and equipment, 6,000 RM. Andaman Berhad cash balance on January 1st, 2004 is expected to be 50.5K. The company wants to maintain a minimum cash balance of 50K, and any surplus will be invested in fixed deposit in the multiple of 1,000, and in case of deficit, cash can be borrowed in the multiple of 1,000. Right? The requirement: prepare a schedule for expected collection for January and February. Prepare a schedule for expected payments for direct material purchases for January and February. Prepare cash budget for January and February. Discuss 4 major benefits to be gained from budgeting. So let's take a look at the answer. The first one, collection schedule. So you put the sales, okay, for November, December, January, okay, February, and for the current month, and the first and the second. So this is the calculations. So you get the total for January and February. Okay, and the payment schedule for direct material. Okay, November, December, January, February. Even though for January, February, you have to calculate, okay, these 2 months. So this is the way how to do it. 50% in the first month, 30% in the second month, 20% in the third month for the payment schedule of direct material. So you get the total. And this is the cash budget. So beginning balance, collections, okay, share of sales, equipment, cash available, and then this is the disbursement, direct material, direct labor, manufacturing overhead, selling and admin, and we get the total disbursements, and then we calculate the excess, or we get the deficiency, and then if we get the deficiency, then we have to borrow. Okay, so this is the ending balance for January, and then become the beginning balance for February, and then we calculate the same way, and we get the ending balance of 50.5K by borrowing 20,000. So what are the benefits of budgeting? There are so many benefits